On a whim, I just got a property manager, started to rent it out, and that was kind of where I got this taste of cash flow. And that was back in 2009, 2010. And when I mean the numbers, you look at this thing called the rent to value ratio, where you take the monthly rents divided by the purchase price. If that is not anywhere near 1% or higher, it's not going to work. Like it might be a great place to live, great school district, but we're trying to find good rental properties that cash flow. And that was kind of why I started to buy these turnkey rentals out in Birmingham, Atlanta, Indianapolis.
You have found Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. Downloadable audio episodes can be found in the podcast link found at drawincustomers.com. We are locally underwritten by the Bank of Sun Prairie, Calls on Call Extraordinary Answering Service, as well as the Bold Business Book. And today we're welcoming / preparing to learn from Lane Kawaoka. Hopefully I did that okay, Lane, of the Wealth Elevator. We're talking real estate investing here. So Lane, how is it going today?
It's good. Aloha, everybody. Thanks for having me, James.
Yeah, thank you. I'm excited you're in Hawaii, but were you born and raised in Hawaii?
Um, I grew up here, but I spent maybe a dozen years up in the cold, wet Seattle.
All right. Oh, yeah. Okay. Fair. How did you end up getting in real estate investing?
Yeah, I guess like my path, I graduated college. Up until that point, was always taught to go to school, study hard. I eventually became an engineer, which is, if you're looking to not go to too much postgraduate doctor degree, you get paid the most out of college, right? And that's what I did. I got paid a decent salary right out of college, and I saved up to buy a house to live in, because that's what we're all blindly taught to do, that in the 401k. Bought that house to live in my early 20s, and here I am living all by myself. And I had this job where I would travel all over for work, and I was a construction supervisor, and I was never home. So on a whim, I just got a property manager, started to rent it out, and that was kind of where I got this taste of cash flow. And that was back in 2009, 2010.
All right. So were you renting it out Airbnb type stuff because you would come back to it, or you just rented it out and you'd stay somewhere else?
Yeah, long-term rental. I was homeless basically for several years there.
All right.
Not really, but I was living off the company dime from hotel to hotel. So what this did is it turbocharged my savings. Like before that, most of my clients today, they're able to save, $50,000, $100,000 a year. Back then I was, those are the doctors and dentists guys out there, or business owners. But at the time, I was maybe saving 30 grand a year. That's how I was able to save up 80 grand down payment a couple years out of college. But when I was, quote unquote, homeless, I was turbocharging that to six figures every single year. And that went to buying more and more rentals from 2009 to 2015. 2015, I had 11 rental properties. There was a little bit of switch that happened in the middle. Stopped buying, had a few units in Seattle, but Seattle is a primary market like California, Hawaii, New York, San Francisco. It's just not going to work in terms of the numbers. And when I mean the numbers, you look at this thing called the rent to value ratio, where you take the monthly rents divided by the purchase price. If that is not anywhere near 1% or higher, it's not going to work. Like it might be a great place to live, great school district, but we're trying to find good rental properties that cash flow. And that was kind of why I started to buy these turnkey rentals out in Birmingham, Atlanta, Indianapolis. And that was kind of the formula up until 2015.
All right. What changed in 2015?
2015, like I said, I had 11 rental properties, and this is kind of what I talk about in my book. For higher net worth investors, once you get past $1 million net worth, you start to realize that you're a target for lawsuits and litigations. And when you're under that, not giving legal advice here, you're not really a target per se. But this is why you don't really want to own little rental properties after a certain point. And in my book, I have kind of a chart, when does that switch happen? But, essentially that's when becoming a credit investor, right? Net worth $1 million or greater, or, $200,000 a year income or greater. kind of puts in that category to not mess around with small little rental properties and the headaches that come with that. And oh, by the way, you get the debt in your name when you do that type of stuff. And what I discovered at this time is, I'm sure you talk about on your podcast a lot. It's all your network, right? The people you hang out with, the five people you become the five people you hang out with. Up until this point, my parents were not wealthy. They were not accredited investors. I didn't have a rich uncle. So I was just kind of doing this all by myself, and kind of haphazardly, I kind of met up with a bunch of accredited investors at that point. Started to understand what the heck that word means, and started to realize I need to surround myself with those types of people. And I started hearing these best practices that I later put into the book of what the wealthy people do with multi-million dollars of net worth. And a lot of them had the same story that I did. They bought little rental properties judiciously, good savers, ran their businesses, and then they parlayed that into bigger deals as a passive investor in syndications and private placements, which, if you're kind of wondering what that is, the analogy I like to use, it's kind of like an airplane, in a deal. The cockpit is your pilots and co-pilots. Those are your general partners, sponsors, operators that do everything in the deal. They find the deal, they get the lending in their name, they run it, they distribute, etc. And then the passive investors are now allowed to just come on coach and ride, right, and go to sleep. But this allows them to diversify into many, many different assets across the board, right? Apartments, self-storage facilities, mobile home parks, venture capital, private equity, buying businesses too, and allows them to kind of put the best people in the cockpit to fly the airplane. But the big difference here is, if you notice, you're cutting out the middlemen, right? Like, you can invest in REITs and other Wall Street products, but there's just so many middlemen in those things, and very little profits and returns go to investors at the end of the day.
That's fair. You touched on a lot of things there, Lane. So I'm going to hit one that's a very important point for everyone, regardless of what you're doing, job, investment, whatever, is that you become essentially who you surround yourself with. So who you hang out with, which means you got to make sure you're hanging out with people that you want to become or that you like hanging around with. And that goes, I think it's safe to say, finances, health, weight, income, whatever, just insert, I'm going to call it a data metric here. You hang out with your people, you take the average, and typically you'll find, well, the average, that's where I'm at. So you're a smart man to find that crowd and hang out with that syndication crowd, and then you end up becoming in the average there. So that's cool. That's very cool.
Yeah, that's the hard part, though, right? Like, when you're a beginner in anything, you're gonna get access to the free groups out there, and typically it's probably on the other end of the spectrum. It's absolutely people you don't want to hang out with. Although sometimes there's a diamond in the rough with somebody with similar trajectory as yours, similar. Everybody has similar aspirations, of course, but who has the follow through, right? That's what you're
Right.
trying to figure out. A lot of these groups were pay to play groups. I mean, that's kind of what separates, like, the weekend warrior who goes to the local real estate club, who thinks they want to get rich fixing and flipping properties, where obviously we're not fixing, flipping properties. We've got money and we're going to buy and hold and slowly value add over the years. But just I remember, like, even speaking from my business side, right? Like, they always tell you, hey, get out there and network with other entrepreneurs. You need, especially if they're outside your industry. But when you go to random networking events that are uncurated, typically you find people who are just getting started, and inherently, not that they're bad people, but that's just where they are in terms of the life cycle. They're out there for themselves. So you have a lot of these, like, it's just a waste of time, right? Everybody's looking to get what they can get
I always joke it's
because
just a
they're trying
bunch
to
of
get off the
sharks
ground.
trying to sell each other.
Well, it's just a bunch of, like, minnows trying to, crabs in a bucket, trying to pull each other down, essentially.
Mm-hmm. Yeah, it's interesting because the networking groups that I'm been in, attended, all that kind of stuff. You can have the checklist, right? You got the mortgage broker, the life insurance sales guy, the personal property lines insurance, insert all the basic things there. And it's just, they have no interest necessarily in learning about what you have or growing. And then piggybacking on that, you think, would Warren Buffett come to a place like this and just network around, try the chicken wings or whatever that they have at this event? Or, like, what are we trying to do here? Who are you trying to hang out with to become? So it's a very smart move.
Yeah, I mean, then again, has he gone to these things 80 years ago? Perhaps.
I don't know if they
It's a
had them 80
start.
years ago. I don't
Yeah,
know.
it's a start. You got to start somewhere, but I would say as soon as you start to pay for things, and as soon as you start to pay $10, the main things start to happen. I would say.
Right, that's fair. You know, you mentioned the real estate investing groups. I was interviewing a guy, this is years ago, that's got a real estate investment group locally here. And I asked him, of the people that go there, that pay the nut, whatever, to be members of this thing and they go to the classes, how many are actually investing in real estate? And he surprised me with the answer because I think it was right in the neighborhood of 25% of the people actually ended up investing in real estate. You know, those 25% they did well, but 75% of them just went to the classes and kind of were just, I don't know, hoping or wishing. I don't know why they didn't actually pull the trigger, but it's interesting that only 1 out of 4 actually ended up investing. So I don't know if that's your experience at all.
Yeah, I mean, if you're talking general real estate investing groups, like eh, the thing about real estate is you need capital to get into the game. It's a capital intensive business. Like I've always taught our folks to buy properties 20% down. And like I guess there are strategies out there that people like to tout on YouTube videos that no money down, but to me, like you trade time for money in that circumstance, and it's just to me, it ain't gonna happen. Most of our investors are credit investors, and they run successful businesses, and they've got money. So let's just jump them up on the literally the second floor of the wealth elevator. Is kind of what we call it in our construct in my book. But that's like I think that's the biggest thing. There's a barrier to entry, and whether certain businesses have barrier to entry, like a CrossFit gym has a very low barrier to entry. You get a bunch of bumper plates, some equipment, 10, 20 grand, you've got a great gym. Quite the opposite with Warren Buffett's railroad, right? How much you need to start a railroad? I don't know, billions of dollars,
A
right,
lot,
in
a lot.
infrastructure.
Your capital expense
Bear
is insane. Yeah.
Right. So, buying a little rental property is along that spectrum, a little bit on the starter side, but you still need $20,000, $30,000 to buy $100,000 house out there. And that can be a bad thing, but barriers to entries can also be good things too. So whatever business you're in, you can think, well, what moat do I have of my businesses? Where's competition coming in? What's their barrier to coming and competing directly with me? And that's why I like real estate, and that's why we've kind of gravitated more to commercial properties, apartment buildings over 50, 100 units, because typically you have to buy them with more than 10 to 20 million dollars, and you have to get $2 to $5 million down payment just to buy one of those things. It definitely thins the herd of our competition. So we feel like in terms of course, you've got the big institutions buying large properties too, right? But the competition is less fierce than the armies of mom and pop investors out there buying properties under $5 million.
That is so true. I can tell you, me looking at properties around here, I'm just outside of Madison, Wisconsin. And I'm like, I'm talking with some buddies and I'm telling them, I don't understand for the multifamily stuff here. It just, the math doesn't work from a cash flow perspective. Like, why are people even buying these properties if they're not cash flowing? Because I look at it as you're essentially buying a business. That apartment unit is offering the service of living space to people and they pay you and you look at revenue, profit and loss and all this kind of stuff. And I'm just not seeing the profit margin on these places. And their counter was their people are banking on appreciation. And I saw on your website that you talked about that. That was what did you call it? Speculation, is that right? Something like that, where it's
Yeah, yeah. There's two kinds of appreciation out there. There's market appreciation, which I think is what you're talking, right? Dumbass luck. You buy property, it goes up with appreciation. But the second one we try and focus on is what's called force appreciation, where you're increasing the value of the asset, and whether it's a apartment building, a single family home, or a business, that in real estate that's called net operating income, your income minus expenses. In the business world, everybody talks about EBITDA, right? Earnings before expenses and debt service. And essentially, if you try, the name of the game is two things: increase the revenue or income, decrease expenses. So in apartments, it's very simple. What we do, we try and increase the revenue by improving the living conditions, kicking out the riffraff. New, typically, what we'll do is the same. It sounds super boring, but this is why we like real estate, right? This is why the caps are so low in real estate because it's an archaic business plan. Change out the flooring, appliances, paint job, new playground equipment. Maybe put 5-10 grand per unit and bump the rents up by $100. And if you somewhat keep the expenses where there are, or maybe even lower expensive with better management, you've increased the value of that property by, the factor of what the market cap is. No different than, if you run a marketing agency and you just talk to one guy and he brings you 10 new clients, you just bump your income right there. Obviously, that's a lot more volatile and a lot more risky, but there's a lot more upside there, which is why we also look at buying other businesses too as private equity. So we're kind of in both buckets, the real estate bucket. There's reasons why we like that, obviously, and then for the higher upside and inclined higher risk, we like venture capital and private equity too, buying businesses or going into new ventures like that.
All right. So you're in investing in businesses as well beyond just real estate?
Yeah, so we're in the business of and I talk about this concept in my book, right? Like in my book, I talk about the different floors of the wealth elevator, which is synonymous with the life cycle of an investor or a wealthy person, right? When you're in the beginning stages, under a million, under a few $1 million net worth, you're kind of on that first or second floor of the wealth elevator. You might buy little rental properties. You're probably running your own business, right? The idea is to create value in your business, or maybe your business is being a little landlord and owning a handful of rental properties, as I did from 2009 to 2015. At some point, you kind of switch to being an operator and into more of a passive investor. Now, I can't say when that switch exactly happens, but in the fourth floor above on the wealth elevator, and have a kind of a chart in my book on this. And if people want to grab a book on this, they can shoot my team an email at the wealth elevator, and we'll get you hooked up with a free copy. But $100 million net worth families, right? These are what's called as quote unquote family offices. They may be still doing their family business that initially got that step up in net worth there, but more than likely they've realized that their best and highest use for their time and money is that they become good damn investors and they diversify their holdings. And they can't be the operator in everything. Now, maybe if they become an apartment operator, they can focus on that, but that's not diversification, right? I mean, that's me, right? Like in 2023 to 2024, there was a big correction in commercial real estate. Everything went down 20 to 30%, which is why now's a great time to get involved in commercial real estate. And I had 90% plus of my net worth in that stuff, and I got hit super hard. but,
Oh, you
but
were in
that
commercial
concentration
real
probably got
estate.
me there.
Okay. Interesting. Okay. That's interesting. I thought for a second there, I thought you meant the residential stuff. I'm like, oh, we're in a bubble because where
Yeah, I
we
mean,
are it went
it's
up.
totally different. It's
Okay.
totally different. Commercial and residential real estate. Residential
Yeah.
real estate, you haven't had that dynamic happen because people buy properties on a 30-year mortgage, right? So right now, people aren't needing to sell. So therefore, you don't test the supply and demand dynamic. But in commercial real estate, people buy properties on anywhere from like a year loan to a 9-year loan, 10-year loan.
Hmm.
It might be amortized over 25, 30 years, but the loan terms are a lot shorter. And this is why you have this dynamic where you can have pricing move more dynamically with the market as opposed to saying somewhat fixed with the residential world. Um,
Yeah. You're having to refinance every few years with a
Correct,
commercial
correct.
property.
And
Yeah.
and if you have a dynamic where interest rates skyrocket on you, 40-year high is what we've had, quickest time in history, you have a period where, buyers stop buying. I mean, we stopped buying after the summer of 2022 for a couple of years. I couldn't make the numbers work
All
on these
right.
things, and I still have a trouble finding deals that work in this sector.
This is for commercial property.
Commercial properties,
Okay.
which
All
which
right.
is, I mean, I think a great case in point is office space. Obviously, there's other dynamics with work from home and stuff like that that exasperates this, but you see properties that were selling for like millions trade for like 20 cents, 30 cents on the dollar. Obviously, apartments haven't come down that much in terms of discount, but it's still kind of, you see it out there.
You do see the discount in apartments in large apartment complexes.
Yeah, yeah. I mean, office space, I think, I mean, you have like the individual case in points where you have that skyscraper, I forget where, like in San Francisco, that is trading for less than half. I'm pretty confident saying that, yeah, less than half than what it was at the peak. Apartments, there's still a fundamental good dynamic on it, which is why we invest in this stuff, right? Like my investment thesis, and this is not financial advice, is just what I invest off of is I want to invest off like a common need of people, and I see the dynamic of the rich getting richer and the poor getting poorer, and the lower middle class becoming more lower middle class, living in apartments, kind of becoming. I think you're starting to see the younger generations. They typically live in apartments anyway, but long term, they're not going to be able to afford a house, especially with their stagnant wages. That's been the same since the last decade or two. And I think that growing demand and an increasing population in the lower end spectrum, I think that points to good fundamentals for apartments.
Yeah, it's interesting. I look around us and we have apartment buildings going up everywhere. To the point that I asked my kid, I'm like, hey, let's go for a motorcycle ride. And he's like, all we're going to see is corn and apartments. And I was like, hey, you're not wrong. So, anyways, it's interesting because I was talking to other real estate buddies of mine. And I'm like, who's moving into these places? And according to their numbers, we're still locally in the southern Wisconsin area. We are still, I don't know what the nomenclature that they use. Essentially, more people are coming in than there are places to put them. So that's why there's all these buildings going up. But I don't. Is that the case, or is that? Are you aware of that on a nationwide level, or is that just
Yeah, and that's
anomalies?
why I like investing in real estate, and I like to kind of self-direct my money. I don't invest in stocks, bonds, mutual funds, because with that stuff you can't do insider trading, right? But with real estate, you better be doing insider trading, right? You better be picking the markets that have increasing population, and a lot of this data is readily available. You can probably use ChatGPT and figure out very quickly, hey, which cities are your more growing cities. Um, and then you from there you look at the sub markets. But even if population was flat or projected to be somewhat coming down, I still look at like, okay, what part of the population, right? Again, I like to invest in the lower middle class. What's called is the workforce housing, the average Joe that makes 40 to $60,000, maybe a little bit less, and they can afford is $800 to $1,200 apartment complex, and even that might be stretching them a little bit.
Tell me, you mentioned the B and C level stuff on your website as far as investing. Can you, just for the crowd, differentiate between? I imagine there's an A, a B, and a C. What is the difference between those three? Is it just finishes? Is it location and finishes, parking? Just speak to that so we understand.
Yeah, yeah. So you can, kind of the quick and dirty on, speaking the lingo a little bit with real estate investors. We'll typically grade properties in terms of grades, right? Just like grade school, A, B, C, where A is your nicer properties, and you typically can call it just by the age, the vintage of the properties. There's no hard and fast rule, but for the most part these days, anything built 1995 or newer is going to be your Class A stuff. Class B is going to be 1980s, and then Class C is going to be 1960s and below. Um, Obviously, I didn't make it perfect because it's not perfect. It's a little bit of touch and go here or there, and then your Class D or War Zone is kind of older than that, right? And I think you also grade the neighborhoods too. You have A, B, and C too. That's a little bit more subjective. Class A is, I would think, a lot of where the listeners are living these days. Best school districts, safe, really safe. Class B is relatively safe. You probably don't want to be there at nighttime. Class C is, you're only going there to get the cheap good eats out there, and you're getting the hell out of there. And then obviously Warzone from there. But as an investor, you're not going to get the best pricing, the rent to value ratios in those Class A areas and properties. You've got to go a little bit to the lower end, but don't go to the war zone, right? There's a sweet spot in the middle. Buying B and C apartments in B or better areas is kind of the idea, because you can value add the property, right? You can take a 1960s property, put a little lipstick on a pig, and have it rent for the same as like a 1990s property,
All
right?
right. You
That's kind of the
mentioned
business
war
behind it.
zone. Is that your nomenclature, or is that just universal between the real estate investors that like
Yeah, that's what
stay
we
away from
call it,
that?
right? And then, if you're talking with a real estate broker, those guys always sandbag you and trying to get you to buy. So whatever a real estate broker says, general rule is lower grade, right? Like, hey, James, I got a great Class B property. I'm like, all right, let me see this thing. This is a piece of junk in a garbage area. It's probably a Class C property, a Class C area, right?
Got it. Tell me, Lane, when you were investing on your own, you start out with your house, you rent that out. How did you get from there to doing all this, bringing on other investors and investing in businesses? What
Yeah, I mean,
was the transition there?
it starts off like watching grass grow, and I'll highlight, like, yeah, I started to buy the first property in 2009. And the way, at least the way I teach it, you're limited to how much money you can save, right? Like, I was moving along at a pretty good clip, adding $100,000 every single year to the war chest, buying properties. But even at that clip, it took me, 6-7 years to get to double digit properties at that point. Um, and it took me that long to get to accredited investor status, which then I kind of parlayed that to getting into deal access and building my relationships with other people in the industry. So I would say, you know, for most part, people just need to get their net worth past the $1 million net worth threshold. And then you have to start interacting with the right people. And that's what we kind of provide. If you don't make $50,000-$100,000 a year, I'm probably not the guy to talk to, right? Like, there's
Sure.
a lot of, like, fake it till they make it operators that tell you can buy properties and no money down. I've never done that. Whatever. I'm not the guy to follow for that. But what I personally do is, like, I saw an underserved community of accredited investors, people who did get to a handful of rental properties and wondering, like, what's next, because this isn't scalable. With 11 rental properties, I had maybe an eviction or two every single month, right? I mean, this is 11, right? Which is actually
Wow.
not bad. And some kind of big issue that happened every single quarter, like a tree falling in a house or a windstorm knocks a tree down, something like that. And with 11 properties, it's not too bad, right? Because I always tell everybody, get a professional property manager to do your dirty work for you. But with 11 rental properties at a few $100s a cash flow per property, that's only a few $1,000s a month, which isn't bad, right? I mean, I'm sure a lot of people would love to have that, and I don't want to sound, like, not appreciative or anything like that, but most of my clients today aspire to, five figures, $10,000 to $15,000 of passive income a month. And you do the numbers, you need damn near 30 or 40 of those rental properties. So that's where the switch to being more of a passive investor in more scale models come in. But you got to get to that point first. But once you do, that's why we have our events of accredited investors, and this is where people kind of meet to get into the next step.
How do you tell me about the accredited investors, getting them to invest? Because there's multiple people or companies that are offering investment. I'm going to say products. I don't know if that's the nomenclature that's correct. How do you differentiate yourself from the other investments that are out there?
Yeah, I mean, you go to, like, the local real estate club, you got a whole bunch of people like, hey, I got a deal, I got a deal, I got a deal, right? Um, this is kind of where I've invested with, in my first 15 deals I went into as an investor. I would say a few of them, or one out of five of them, were probably like, shoot, I shouldn't have invested with that person or that deal. I just didn't know any better. But fast forward today, we've got a pretty good process, as an operator of, over thousands of units myself. Understand when you go into a deal, there's some lessons learned, obviously. So, I've got a pretty good process today. Got a team. We go in and underwrite the deal. We take the P&Ls, we take the rent rolls, we analyze it ourselves, stress test it, right? We may not agree with certain assumptions that the operator might be making. They may assume that they're running the property at 95% occupancy. I know very well that's not going to happen, right? I know they're going to probably have 8% vacancy and another 3 to 5% of economic vacancy on top of that. And that's just one of maybe a couple dozen big impactful things that really impact the underwriting and projections at the end of the day. And then, so that's the number side. So, on my website, we teach a lot of this in our free e-course. People join the list, they can get access to this free content. But I think the biggest part, the other half of the equation is, who the heck is this person? What's their track record? Because we're kind of in this private world of, there's no website for these people. They're not institutional. So one of the rules I have is I try not to work with anybody who has done less than $1 billion of deals in the past.
Did you say
there's
billion with a B?
yes, 1 billion. So you have a lot of these guys running around saying I did $300 million of deals. Like, that's nothing. That really is nothing in the commercial real estate world. Um, I think once you go over $4 to $5 billion, you're definitely more on the institutional level. But at that point, then the splits and fees go more in the favor of the operator than the passive investor. So there's a little bit of a sweet spot there in a way of being a passive investor. So there's a big gamesmanship to this, as you can see, that I kind of talk about in the e-course that I have, which is for free. Like, look, guys, just, I'm not trying to sell anything. None of this like ridiculousness, real estate education stuff. Everything's for free. What we do charge is for the network, right? Our events and our mastermind group, and that's where you tap into interacting with people. But a lot of this content is out there. It's very specialized knowledge, I think. But I think for our credit investors, it's critical to getting out of that landlord mode and into bigger and better things. And for a lot of business owners who run successful businesses, I'm in Vistage and EO myself, probably makes sense for them just to skip over buying little rental properties and straight to the second floor of the wealth elevator. But yeah, I didn't realize, like, there's, as you move through the journey, there's different pivots to the strategy. Rental properties, I think I might have talked badly about it, but if you're under $1 million net worth, I think that's the place to play. But to know that there's pivots around the strategy.
Oh, just build upon your success. So it's interesting, as I'm hearing you talk, there's people that are going to listen to this that are like, I don't have $1 million. But you don't necessarily need $1 million to start. You start with your little thing with a duplex or something like that, or even a single family rental. Get that going and cash flowing and stuff like that, and then just build upon that.
Yeah, 20, 30 grand down payment on $100,000 house, you're off and rolling.
Mm-hmm.
Knowing the audience that you have, James, because you have a lot of business owners, I would probably say that your highest ROI is not going to be in a little rental property where you're going to make less than 10 to 15%. It's probably going to be better off taking that 20, 30 grand and hiring a employee. I guess I would pay half their salary for a year, or some, I hate to see it, but some meta ads or whatnot, right? Google ads.
Build your existing business, you're saying.
Right. Invest in yourself. But I think that's where the contra people who are listening now, like, I would say half of my investors are just straight W-2 employees, whether they come to work hungover or busting their butt, they're still going to make the same at their job, right? Which is a good and bad thing. I was kind of on the lucky end of that, right? I could kind of do my side gig on the side of my engineering job when I first started. But, I think people listening are maybe in a different predicament than that. So, real estate is a capital intensive business. You listener, I don't know your personal situation. Your personal situation may mean that you take that 30 grand and put it into your business to then parlay that into selling for, a few $1 million, couple $1 million exit. Then you diversify. And that's kind of what I talk about in the Wealth Elevator book, right? You have to get to these perches. You have to get to these floors and checkpoints.
Tell me the property manager situation. So are you finding property managers for the different properties that you're investing in, or do you have a property management company now?
Yeah, yeah. So when we buy the apartments, we're typically in the role of the asset manager, no different than when you're the landlord, right? When you're a landlord, you're typically, or at least I suggest, get a property manager. Don't dick around with this yourself.
Agreed.
But on the commercial property side, we'll typically get a property management firm that's, on the commercial side. So very different than the residential property manager. Higher quality, they have the advantage of all their units right there. When you get above 50, 60 units, you can typically have a leasing agent at the property 100% of the time. And then the cool thing that happens when you get over 80, 100 units is you can have that on time handyman staff. So I think that's where, if people are landlords right now, they know that when a little plumbing repair happens, they're getting killed with these egregious repair costs, right? $800, $1,000 to fix a freaking toilet. It is what it is. But when you start to get guys on salary, you can have these guys knock them out for you, for a fraction of the cost it would otherwise. Of course, you have the volume to support that work, right? But that's where you get a lot more economies of scale once you get into the commercial properties above 100 units
All
at
right,
that
because they're
point.
bouncing from broken thing to broken thing instead of just waiting for the phone to ring.
Yeah, yeah, but we tend to go through property managers quite often because, at least the way we do it, we're kind of, it's kind of like renting a car in a way. Like, we abuse that thing, right? We're not like, think about what we're doing, right? Like, we're going through, we're renovating units, we're bumping rents, where tenants are cycling in and out. We're not exactly the most ideal lazy landlord client for these firms, right? So we kind of push them for sure too, right? So we tend to go in and out of property managers a bit. Um, it's kind of interesting occupation too, right? Like, it's hard to hire, which is why we use third party, right? When we hire third party, or essentially contractors, if you think about it like that, um, y- you have them be your human resources, which is a huge issue for this particular profile. This profile, you need somebody who is good with people, can think operationally in their head, often independently by themselves, and you know, it's a position that I think you'll find a lot of people straight out of college do, who's got a good head on their shoulders. But once they get a little experience, they get the hell out of there, get a better job, right? Better pay. So I think that's what makes this industry hard. It's not like McDonald's, where you can just stick anybody in there to flip hamburgers, any idiot in there. You have to have somebody that's somewhat smart, but then the pay dynamics is just difficult there, right? So
Oh,
I
I
think
get it.
that's the industry. That's the difficulty for this type of business. Every business has an issue. I think that's mainly ours.
Yeah, that's one of the biggest challenges that we have with employees. One of the biggest challenges, I guess, is finding someone that can problem solve on their own, that is able to think stuff through on a broader scale rather than I just need someone to tell me flip the burger kind of thing. Like there's
Right.
no hamburger you for every single job. So it's one of those things that's interesting trying to find an employee that can think on their own so that you're not having to ask, or I'm sorry, not having to answer questions that you feel like the person should know already if they know how to work a light switch kind of thing.
Yeah, exactly, exactly. And maybe I'm just kind of theorizing here, but with AI kind of differentiates, it kind of polarizes the workforce. Your best people tend to get, they use the benefits of AI, can cut staff. At the lower end employees, and maybe even moderate, mediocre employees, they're devalued in this type of dynamic. So perhaps that helps us. I guess maybe some of the lower end white collar workers that maybe get paid 80, $100,000 a year, now they come back and work for us. I don't know, right? Like,
Yeah, it's tough to
who
say
knows?
where the chips will end up falling at this Web 3.0, I guess, with this. But yeah, it'll be interesting. It'll be very interesting. I guess I could see AI in a business like yours actually looking at deals and maybe helping you differentiate that way.
Yeah, I mean, I differentiate like the AI into different stages in our process, right? Like, we definitely use it to sort things and cut down a lot of the labor intensive stuff. So that definitely helps, and that helps cut down on like the lower end stuff, right? Kind of think about like paralegal kind of work there, sorting and collating. But I think it maybe makes the quality of the research better for the decision makers with the
You
experience
hope.
to then take a look at it later. And but that's kind of where AI, that the road stops with AI
Hmm.
for us. So I think every industry uses it a little bit differently. That's kind of my outlook
Oh,
on it,
absolutely.
or how we use it.
Absolutely. Tell me about the investors that you have, or I should say, let me back up. Tell me about the investments that you have, because the what I have seen with things like this, if I understand correctly, somebody will give. I guess I saw on your website you have so many people that I almost want to say donated. That's not correct. That they invested $50,000 or more. That $50,000 goes towards a project, real estate thing, commercial real estate, residential, whatever it is. And then is that until it's sold, or when does the person, the investor, see a return on that? How does that
Yeah,
typically
so
work with you
so
guys?
going back to that analogy of the airplane, right? Investors come on coach and they invest their amounts. And this is why predominantly it's accredited investors, right? $50,000 is not a huge chunk of their net worth. So in theory, they shouldn't need it, and this is kind of why we definitely try and vet people coming in. Like if you need your $50,000 for whatever reason, we probably don't want you on the plane, right? And like thinking metaphorically on the plane, like once you get on a plane, there's no getting out. This is not a ship where we can like
Yeah,
kind of
right.
drop you off at the next port. We're literally like we can't open the airplane. Like we're in a liquid investments, and that's not what most people are needing. Most people want to emotionally jump from one airplane to the other airplane. That's just not what we do here. That maybe that's like UPS ground shipping or something like that, right? Like we're flying high in these investments that you have less liquidity, right? We're baking bread out here. The bread needs to stay in the oven, right? We're renovating units. Not going to do this like overnight or in a year or two. Sometimes it takes a lot longer than that. So all good things, for those who are patient, for sure. But um, this is the way investors invest. They have a big chunk of their net worth into alternative investments off of Wall Street, into these sound investments that they deem as, that fits their investment criteria. Now, most people out there, can't even afford a house to live in, of course, right? But most people, even with some money, should not invest in these types of investments. They should just go after the standard American 60/40 portfolio, right? What we're talking about is the investing for the wealthy.
Yeah, totally understand. It's interesting because I was putting together a book on money, and I have essentially a graph of money that's liquid and then not liquid as far as investments go. And something like this, I can see like if grandma gets cancer and you need $50,000, this $50,000 that you invested with Lane, that's not accessible. I don't, unless maybe you can people borrow money against it? I don't know if that's a thing or not.
I'm sure they can, but no. The answer
Okay,
is
no,
no.
no,
You're like
no.
no, go away. I mean, this is like it's kind of one of those things where it's like, and this is what I always what I realize is like if you don't know anybody in this world, you don't even know this world exists, right? You just have a
Right.
guy in the cubicle next to you who's doing his 401k or his pension if he's old enough. I didn't have anybody that I knew wasn't accredited. My parents weren't wealthy. They never had rental properties. I didn't know this world existed. But very quietly, there's the wealthy whisperer out there, and a lot of people are doing this, even though if it's like 0.001% of the population out there, whatever it may be. What I realized what the wealthy do is essentially three things. They invest in alternative investments, better deals that are directly with the operator sponsor to cut out the middleman. In doing that, like real estate, you get a lot of tax benefits, the depreciation, bonus depreciation now 100%. You pay a lot less taxes. And then they also manipulate whole life insurance, infinite banking. You've probably heard the term out there. There's different ways to configure it even under that construct. But this trifecta is essentially what the wealthy do. it's very implementable by the average person, but very counterintuitive than what we're all taught, like what my parents taught me.
Mm-hmm.
And that's what what I realize. And unless you meet other people to distill down the stories and the best practices, you don't really, you just kind of revert back to what we're all taught to do, right? Which is put out there by the big brokerage companies. They want you to invest in their garbage,
Yeah.
right?
Trade
Um,
time for money. Take that money and invest in these other companies so that they can get rich. And then hope
invest in
that
their
you.
products, the derivatives that they have high fees, hidden fees, structures, and and hopefully you like their certified financial planner, right? I'm not a certified financial planner. Should have said at the start. I'm not, not paid. I can't get paid to sell marketable securities apparently, and I don't know anything about finances, right? But
Yeah.
one
It's
thing
a,
I would say is, one thing I've learned is you never take financial advice from people who are not financially free. Typically, those guys are just salesmen
that's
doing it.
perfect. Perfect right there. I was talking with someone about financial planners, and they're like, our financial planner is this, that, and the other thing. And I told
Typically, a
them,
nice guy, right?
yeah,
Typically, nice
yeah, yeah, we've known him
guys.
for years. And I was trying to figure out how am I going to say this without insulting them? Because I'm like, if your financial planner really knew what they were doing, they wouldn't be talking to you. At least they wouldn't be talking to you about finances because they could afford to be anywhere else except for talking to you at your kitchen table about how you're going to retire in 15 or 20 years or whatever. They don't know what they're doing. So that was just me from my perspective, the experience that I've
Yeah.
had with financial
I mean,
planners.
like,
Yeah.
in my book, I've got like things for the people when you get above $10 million net worth. I do think that, the some of the strategies that they employ with some closed-end funds, more advanced strategies, it does make sense to bring somebody on like that for the portion of your portfolio for very specific purposes. But if you're talking somebody under $5 million net worth, typically you don't have access to that type of practitioner,
Right.
right?
Yeah.
So there's a little bit of like nuances to this, right? But yeah, for your average, financial planner, that may be the case. But I'm not, this is where I've always been like, I've changed my mind through a few times. Obviously, at one time I thought buying little rental properties was like the best thing since sliced bread. As I always kind of take and grow my network with people on the next level up, the next level up. And now a lot of those people are like on the family office level, multi-generation wealthy, and to seeing what they do makes me feel confident that I'm heading into the right direction. But there's things that I realize that the wealthy do things very differently. Like, just talking with our colleague the other day on, I like houses. Like, this is more of a fun one. I mean, maybe not good financial advice here, but like the wealthy people that with 20, $50 million plus net worth, they don't go and buy big ass mansions. Those are the only things that the silly athletes do. They buy $20 million house. Typically what they do is they buy, very modest $5 million homes, and a bunch of them, so that their hierarchy, their kids can use it, and it's diversified, right, than to consolidate into these monstrosities of houses. And I was like, it makes sense, but I would have never known, right? It's like
Yeah.
things like that.
Yeah. I remember visiting Vale with a buddy of mine. His sister lives out there. And we're looking at these houses that are up the mountain. And the houses themselves are relatively small, but you also got to figure in order for them to be built, somebody used dynamite to get into the mountain. And we were with someone that was from there, and they're like, these aren't where people live. These are seventh houses for people. Like, this is just, they're going skiing in Vale. This is where they stay. They own this house. They also have whatever, 5 or 10 other houses all across the world. Like,
Right.
oh, I didn't know that was a thing.
Yeah. The only rich people I knew was like the athletes, and I saw Michael Jordan selling his $25 million house. That's the only, like, unless, and that's what I'm talking about, right? Like, you see the loud money people that obviously didn't grow with it, but then the wealthy people are the people. There's whispering, right? Like, money talks, but wealth whispers is the saying, right? But very quietly, if you know what you're looking for, you can see the signs of what wealthy people in there are doing.
I love
And
that.
that's
It's
what
like,
I put in the book, The Wealth Elevator, right? Like kind of this concept of like what is it that the wealthy doing in this construct of the different levels of it. And that's what I would say, take a listen to the book or read the book, and that's the first step, is figure out what floor of the wealth elevator you're at now, and understanding what's the next level and the next level above that to kind of see the path forward.
I love that. Tell me more about your book.
Um,
Like,
it's
what
not
was
a
the
book.
inspiration to
It's not
write
a
it?
book written for the average guy.
Okay.
That's for sure.
All right.
I always thought that there was way too many books for that. Dave Ramsey, Susie Orman, even the Rich Dad Poor Dad book. It's kind of that one is super vague and actionless, if you ask me.
Right. Someone use other people's money.
Yeah,
Where is
yeah,
it?
yeah. I mean, don't get me wrong. I think that the message that is said 1,000 different ways is by assets, right? Especially in an inflationary environment. Definitely thinks he goes a little bit off the deep end with all like the. I'm very non-political. I think it's a waste of time, right? I like to see where the puck is going, and I skate the puck quietly.
Hmm.
And to me, like like you understand that what floor of the wealth elevator you're at. If you're under $1 million net worth, buy a little amount of properties, build your net worth to get up to the plate. But just know that there is a pivot point once you become an accredited investor, and then there's another pivot point that I think most of people get when they get to $4 or $5 million net worth. At that point, it's very critical that you make a switch to your time is more valuable than money. At that point, you could change your portfolio completely to just put it in T-bills and life insurance and very low risk, low return investments and be totally fine. Whether you want to push it to 8 figures, wealth elevator floor and higher, that's up to you, but you have that choice. Great book out there, Bill Perkins, Die with Zero. I had him on my podcast, but that's his whole concept is, for some people out there above a few $1 million net worth, time is more valued than money. It's not the pursuit of money anymore, but it's the pursuit of trading in the money for the experiences is the main thing in there. But, I think a lot of my curriculum is not really there quite yet. I think it touches there, but like I think our sweet spot is for the guys who make at least 6 figures at their day jobs or their businesses. And you got to get on this elevator. Like you got to get on this moving platform, buying assets, ideally real estate or private equity these days, um, because the puck keeps moving, right? Like I think real estate was really great a decade ago, but the environment is changing, right? The Fed's not going to lower rates under 3%. Here's another tip. Everybody should have the Chatham Financial Curve and the CME FedWatch tool bookmarked. Don't listen to any of this garbage on YouTube on interest rates. Just monitor those two because those are like what the pros monitor. Those are the interest rate cap providers that operators like us will buy when we buy loans. So they've got skin in the game. They're like the Vegas odds people, but they're predicting that the interest rates aren't going to be coming under 3%. We're talking Fed rates here, right? Not talking 10-year Treasury or mortgage rates, but the Fed rate is what impacts the rest of it.
Hmm.
They're not predicting it to go anywhere near where it was at 0%.
No, no.
Yeah,
In my mind, that was an anomaly. Uh, I don't feel like we'd ever see that again.
yeah,
I mean, that was just a weird, weird time. So a lot of things were different that you're not like, oh, it was like that in 2020. Let's do that again. I don't see that happening.
yeah.
No,
I mean,
I get.
real estate is a business that is it's an archaic business, as I said earlier. It's a very repeatable business. It's probably going to be around forever. There's good demand dynamics, as I said, with workforce housing, especially. But there are it is dependent on interest rates and the cost of money because there is a big component to leveraging, using bank loans when you're doing it. So, that says that kind of puts into the overall business strategy of it. But I think the assets are sound.
Oh yeah.
Is
Well, people will always need a place to live. So it's
right,
one of those
right.
like it's a very, from my point of view, it's a very safe, broad vertical to be in. rather than being, I don't know, like there's probably somebody that invested in typewriters 30 years ago and they're not doing so hot, thinking, hey, people are going to have to write letters forever. Like that technology changes where houses, we got 4 walls, a roof, and a floor. That's kind of where we're at from a technology point of view of where we can live.
Yeah.
So,
But I mean, I guess warning sign for esoteric advice here. But like whenever you invest, there's always the business need for the investment, which I think what you're talking about there. But there's always a macroeconomic climate that surrounds it, right? That you don't have control over. So there's in
true.
this high level example, there's two big factors. There's obviously probably other few factors that we're not thinking of or unaware of, but in every investment there is unknowns and there's risks, right? But I think people need to ask themselves the question: if I just keep it the status quo, where will I be? And for some of you folks listening out there, you may want to just do 100% in your business and gamble on yourself. That may be your highest and your best risk adjusted return. I don't know, right? But
No,
each
it's
their
tough to
own.
say. I always like to have diversity. I was told, I feel like the smartest people that I know financially do not have all of their eggs in one basket.
Yeah,
So
yeah.
they just spread them out, whether that's, I mean,
Well,
all kinds of different ways.
that's a self-selecting bias,
Totally.
right? The people who have already made it, which is why they're on the other side of the downhill slope.
Mm-hmm.
And at that point, yeah, I would agree. You diversify, but when you're trying to ascend the mountain, trying to get your first $1 million or maybe even first $10 million net worth, I think that may be a different story
Oh,
and
it's a good point.
a cause for concentration. I think I forget who's the. I got to get going here soon. I got another
Yeah.
meeting, but I think it was Warren Buffett who said, or somebody said, like, diversification is for idiots. I mean, you can probably have AI figure out who said that one, but
Oh,
again, that's the whole point of my book, right? Is like there's different checkpoints to the journey and different things apply to the journey. And this is what drives me crazy about social media and YouTube shorts and TikTok. There's a lot of these random ass like financial dips out there. Some good, some bad, but perhaps they're all good at different stages of the journey, right? There's a lot of different, medical drugs out there. If you don't have any ailments, they're probably the worst drugs to try at the time, right? It all depends on your situation and where you are in this journey, this paradigm. And
very true. I
that's
love that.
essentially the idea behind the book is, really trying to define these different stages of through these floors.
I love that. That's an interesting point, right? Just because it's good advice, it may be good for advice for someone, but not necessarily for everyone.
Yeah.
So I like depending upon what stage you're at. That's interesting. I love it. Lane, where can people find you?
If they listen to podcasts, I got my podcasts at the Wealth Elevator. If you're an accredited investor, reach out Lane at thewealthelevator.com. And if you want the quick foray into our world, check out the book on Amazon, The Wealth Elevator. If people pick up a copy, they send the receipt over to email team at thewealthelevator.com. We'll hook them up with the free PDF version and then the audiobook version as a thank you. But yeah, thanks for having me, James.
Yeah, thanks for being on the show. Just really quick, who did the audiobook? Who recorded it?
Oh, me, of course.
Oh,
With all
nice.
my little quirks and side notes and
I love it.
side comments that came half a year after writing the thing.
I love listening to audiobooks, and I love them way more when it's the author that's reading versus some person.
Yeah, I think now, like even on Audible, there's a function where you can have AI read it.
Yeah.
Which I guess with 11 Labs is like the AI tool that's on the forefront of that. It's not bad, right?
It's just
nothing.
it's not
I
authentic.
mean, that's why I try to add in like little quirks or side sarcastic comments here.
I love it. I did the same thing with my books. I totally understand. Yeah, it's cool.
Keeps you from going to sleep, right? Reading your own stuff.
Yeah, it's interesting. I picked up my book. I don't know. I got a bunch of copies to give to people, and I was reading it, and I was like, hey, this is a pretty good book. Yeah. So it was one of those like pat yourself on the back kind of thing, because I know there have been some books, I'm sure business books that you've read, where you're just like, I don't understand how you sold 100,000 copies of this thing. This is kind of, it's either garbage or it can be compacted into a paragraph.
Yeah.
Like this is an essay. This is not a book. Spread out.
Right, or a blog article. It's a glorified blog article.
Yeah. It's got filler. It's like sausage. So, Lane, I appreciate you being on the show.
Yeah, thanks for having me, James.
Thanks. This has been Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. My name is James Kateman, and Authentic Business Adventures is brought to you by Calls on Call, offering call answering and receptionist services for service businesses across the country on the web at callsoncall.com. And of course, the Bold Business Book, a book for the entrepreneur and all of us, available wherever fine books are sold. If you're listening or watching this on the web, if you could do us a huge favor, give it the big old thumbs up, subscribe, and of course, share it with your entrepreneurial friends, especially those friends that may need to know, what do we got here? What level of the elevator they're on in their finances, where to invest as far as their business goes into themselves. And someone's just curious about real estate investing. Lane at the Wealth Elevator has a lot of information. We'd like to thank you, our wonderful listeners, as well as our guest. Past episodes can be found morning, noon, and night at the podcast link found at drawincustomers.com. Thank you for joining us. We will see you next week. I want you to stay awesome. And if you do nothing else, enjoy your business.